Welcome to the deep dive. Today, we're really getting into the core of what makes successful trading possible. We're diving into Dr. Alexander Elder's The New Trading for a
A
Living.
really foundational text for many traders.
Absolutely. And what's so interesting, I think, is Elder's background. He's not just a trader, he's actually a professional psychiatrist.
Right, and that gives him such a unique perspective. He understands that the biggest challenge isn't really the market itself.
It's us, the person clicking the mouse.
Exactly. It's the human element, our own psychology.
Which leads perfectly into his main concept, this idea of the three-legged stool.
Yeah, the three M's: mind, method, and money management. He argues pretty convincingly that if any one of those legs is weak,
The whole thing just collapses, your trading falls apart.
pretty much. So that's our framework for this deep dive today. We need to look at all three.
Okay, let's start with the first M, mind. Elder actually says this is the most important one, doesn't he?
He does. It makes sense when you think about it, because what usually blows up accounts, it's emotions, right?
Oh, definitely. Greed making you hold on way too long, hoping for that extra tick.
Or fear making you slam the sell button at the absolute bottom. We've all felt it.
So the mind leg is all about controlling that internal chaos.
It is. The market itself is, well, impersonal. It doesn't care if you win or lose. It just is.
It's a mechanism,
Yeah,
almost.
yeah, and a very effective one for transferring money from those who are acting on impulse to those who have discipline.
So you can't just wish yourself disciplined. How does Elder suggest we actually, manage this?
Well, it starts with something maybe deceptively simple: a detailed trading journal.
Okay, I think most people know they should keep a journal, track trades.
But this is more than just profits and losses, entry and exit points. He insists you must record your emotional state.
Your emotional state, like what you were feeling when you made the trade.
Exactly. Were you feeling confident, scared? Were you chasing because you felt you missed out? Were you trying to make back money from a loss?
Oof. That sounds confronting.
It is. But that's the point. It forces self-awareness. You have to look honestly at why you took the trade, not just what the trade was.
So the journal becomes a tool for, diagnosing your own emotional patterns.
Precisely. It helps you see where your actual trading deviates from your plan, from your method, because of fear or greed. It turns those impulses into data you can actually analyze and work on.
Okay, so the mind is about self-awareness through the journal. That leads us to the second leg, the method. This is the how-to, the system itself.
Right. If the mind is about controlling your internal state, the method is about having a clear, objective external framework to follow, especially when those emotions flare up.
And Elder leans heavily into technical analysis for this.
Yes, he's a big proponent of using charts and indicators, but not just randomly. He emphasizes having a defined system. His main one is the triple screen trading system.
Triple screen. Okay, walk us through that. It sounds like it's designed to maybe add layers of confirmation.
That's a good way to put it. It forces you to look at the market across 3 different time frames to align your trade with the dominant forces.
So, screen one, what's that about?
Screen 1 is the big picture. The long-term chart, usually weekly, Elder calls this identifying the tide.
The overall market trends, is the sea generally rising or falling?
Exactly. You absolutely do not want to be trying to swim against that main tide. So if the weekly chart shows a strong uptrend, you should fundamentally be looking for buying opportunities, not shorting.
Even if the shorter-term charts look weak?
Yes. You use indicators here, like maybe a weekly MACD, to gauge the direction and strength of that primary tide. Trading with a tide is priority 1.
Okay, tide identified. Then screen two.
Screen 2 is the intermediate time frame, maybe the daily chart. Here, you're looking for the wave.
The wave, like a movement counter to the tide, but temporary?
Right. Markets don't go straight up or down. They move in waves, pullbacks, corrections. So if the tide weekly is rising, on the daily chart, you look for temporary dips or pullbacks. That's your potential entry zone.
So you're not chasing the peak, you're waiting for a pullback within the bigger trend.
Precisely. And here you might use an oscillator, like the RSI or stochastic, to see if the market is temporarily oversold during that pullback in an uptrend, suggesting a good place to potentially get in.
Makes sense. And the third screen.
That's the shortest time frame, maybe an hourly chart or even less. This is where you pinpoint the exact entry. Elder calls this the ripple.
The ripple on the wave, which is moving with the tide.
You got it. It's often about using trailing stops or very short-term price action to find that precise moment to execute the trade, but only in the direction aligned by the first 2 screens.
So it forces patience and alignment across time frames, You can't just jump on a short-term signal if it conflicts with the bigger picture.
Exactly. It builds in that discipline. It's a structured way to approach the market.
Okay, we have mind discipline via the journal, method structure via something like triple screen. That leaves the third M, money management. Elder seems almost religious about this one.
If mind is about not sabotaging yourself and method is about knowing what to do, then money management is about making sure you survive long enough for the other two to work. It's pure risk control.
Survival. That sounds critical.
Yeah.
And he has some very specific, almost famous rules here, right? Starting with the 2% rule.
Yes, the 2% rule is non-negotiable for him. You should never risk more than 2% of your total trading capital on any single trade.
2%. That sounds really small to some people, maybe, especially with smaller accounts. Why so strict?
Because it's about surviving losing streaks. And losing streaks happen to everyone, even the best traders. If you risk, say, 10% per trade, just a few losses in a row can cripple your account.
Right, 5 losses at 10% risk and you're down nearly half your capital. That's hard to come back from.
Extremely hard. But with the 2% rule, even if you lose, say, 10 trades in a row,
Mm-hmm.
which would be awful, but possible,
Mm-hmm.
you've lost less than 20% of your capital. You are absolutely still in the game.
Okay, but how does that 2% translate into actual trading? Does it dictate how many shares I buy?
Yes, directly. This is the clever part. It forces you to link risk to position sizing. First, your method tells you where your stop loss should be, the point where you admit the trade is wrong.
Based on the chart, volatility, support resistance levels, that kind of thing.
Right. Then, you calculate how many shares or contracts you can take, so that if your stop loss is hit, the resulting loss is no more than 2% of your account equity.
Ah, so if a stock is really volatile and needs a wider stop loss?
The 2% rule automatically forces you to take a smaller position size to compensate for that increased risk per share.
It's like a built-in risk governor based on the trade's specific characteristics.
Exactly. It forces you to respect the risk inherent in each setup. And then there's the second layer of defense.
It's the 6% rule.
The 6% rule. This is a monthly cap on losses.
Yeah.
If, at any point during the month, your total account drawdown hits 6% from its value at the start of the month, you stop trading.
Stop completely for the rest of the month.
Yes. Shut it down. No more trading with real money for that calendar month.
Wow. Why? What's the thinking there?
It's a circuit breaker against the deadliest trading sin. Revenge trading.
Trying to desperately win back what you just lost.
Yeah. When you hit a drawdown like 6%, your judgment is almost certainly clouded. You're likely feeling desperate, angry, frustrated. You'll probably start breaking your method rules, taking bigger risks.
Digging the hole deeper.
Precisely. The 6% rule forces you to step away before you do catastrophic damage. It takes the decision out of your emotional hands.
So what are you supposed to do during that forced break? Just sit on your hands?
No, you go back to the journal. You analyze what went wrong. Was it your mind? Did your method fail under current conditions? You switch to a simulator or paper trading. You basically have to diagnose the problem and prove to yourself you've addressed it before you're allowed back in with real capital next month.
It really reinforces that idea of survival first.
Absolutely. Elder says your number one job as a trader isn't making $1 million. It's survival. It's living to trade another day. The profits come from consistent application of mind, method, and money management over the long haul.
Okay, so pulling it all together, mastering these 3 M's isn't about finding some secret indicator, is it?
Not at all. It's about building a robust personal structure, mastering your internal world with the mind focus, having a clear plan with your method, and protecting your capital at all costs with money management.
It's a complete framework for discipline.
That's the key word, discipline. It's not magic, it's work. But this framework gives you the tools.
And it's something you, the listener, probably need to keep coming back to, right? Making sure those legs of the stool are always strong.
Definitely. As you grow, as market conditions change, you constantly need to check in on your mindset, refine your method, and stay disciplined with your money management.
So let's leave you with a final thought, really drawing on that psychiatric insight from Elder. If the market truly doesn't care about you, and the journal is about self-awareness, consider this. How does consciously submitting to rigid external rules like the 2% or 6% limits actually help manage your internal emotional vulnerabilities?
It's like using an external structure to fence in the internal chaos.
Yeah. Think about how those strict, unemotional rules act as guardrails against your own potentially self-destructive feelings when you're in a trade. Something to ponder.